Welcome to hackertrading.com. This is Harry Swaminathan. In this video, I want to show you the difference between your capital requirements when you buy a stock or when you buy an option. So we covered this example in the first video in the series, but what we're looking at is the Google stock. The Google stock, the last traded price of Google was about $560. So if you wanted to buy 100 shares of Google at $560 approximately, then your buying power effect is going to be $28,000. Now, in general, if you have a margin account for stocks, your broker is going to require you to put up 50% of the cost of your purchase as margin. And here Thinkorswim puts this column called the buying power effect, and we have to look at the middle row here which says live, and if you look at that row, what you see is a buying power effect of $28,000. So you're still putting $28,000 as your margin. However, your risk on this trade is the entire $56,000, because if Google goes to zero, then your entire amount of $56,000 is at risk. And we saw how the risk profile works for a stock in the first video in this in the free video section. Now, we also know that one options contract in the US market is equivalent to 100 shares of stock. So what I have here is in the second row is an option contract. So by buying one option contract, we are controlling 100 shares of Google. And what you see here is the July series. The strike price of this option is at 560. So everything that we discuss here are covered in detail in modules 1 and 2. So if there's anything you don't understand, you can find it in module 2. So this is a 560, it's a call option, because when you buy a stock, you're bullish on the stock. And similarly, if you wanted to use options, you would use a call option to take a bullish position. And here, this is the price of this option. So if we come back here and see the 560 call option, you can see that it's going for about between $19.50 and $19.70. But this price that you see is a per share price. So for one contract, which is equivalent to 100 shares, what we would do is we would have to multiply 19.7 into 100. So which means that's $1,970. So to buy one contract or to control 100 shares of Google in the options market, what you would need to do is to buy one contract, and whatever the price is for that option, you would pay that amount. So now let's see, I'm going to uncheck the stock and I'm going to check the options. So that's exactly what you see. If you look at the buying power effect now, it's $1,970. Now, in both cases, you'll see, and we already saw this in the first video, if you look at the risk profile of an option, that's what that looks like. Your maximum loss on this position is going to be 1,970. However, on the upside, you get to participate in any upside move that Google makes. Similarly, if I uncheck the option and I check the stock, you can see that the stock also has a similar profile on the upside. However, on the downside, you're not protected. And we covered this in the first video. So the big difference you can see is that when you buy stock, even if you have a margin account, you're going to have to put up this $28,000 as capital to buy 100 shares of Google. Not only that, if you buy 100 shares of Google, your risk on the downside is unlimited all the way down to zero. If you buy an option for the same amount of shares, so if you buy one contract, you're controlling 100 shares of Google, all you have to pay is 1,970. Not only that, on the downside, your loss is protected to that amount. So this is again a big advantage of using options. We saw that it protects your downside, it protects your losses, Now, the second advantage is capital usage or capital efficiency. So here we are controlling 100 shares of Google with $1,970, whereas if you were to buy 100 shares of Google, and even if you had 50% margin on your stock account, you would still have to pay $28,000. So that's the second big difference between stocks and options. And you're going to see that there are several other advantages as well, and why it makes sense to look at options as a viable instrument to use in the markets. So that's as far as the difference between stocks and options when it comes to capital efficiency and capital usage. Thanks for watching this video, and I'll see you in the next one.